The closing bell is ringing on the wildest week in the energy market since 1985. Oil just surged nearly 40% in 5 days. Trump is demanding an unconditional surrender from Iran, and the Fed is officially trapped. Welcome to the Friday close.
Wow. Yeah, the term structure in the oil futures market right now is just completely broken. We aren't just seeing a standard front-month premium or some speculative bid. We are watching a violent mechanical scramble for physical delivery.
It's absolute chaos on the tape.
It is. You are looking at a historic confluence of a geopolitical black swan materializing in real time, an unprecedented macroeconomic trap closing around the Federal Reserve, and a massive contrarian aerospace catalyst that the broader market is entirely mispricing because it's just blinded by the macro panic.
Right, and that is exactly the mission for this deep dive. You are walking into a weekend with extreme gap risk, and you cannot afford to be caught offside when the opening bell rings on Monday. We are treating this as a war room strategy session. We are hunting for the structural trades hidden underneath the tape, and we are going to tear down the mechanics of this panic so you can manage your risk, especially if you are managing an options portfolio. So let's put the numbers on the table because the action right at the Friday close was just breathtaking. U.S. crude, WTI, just punched through $92 a barrel.
Yeah.
Brent is knocking on the door of $95. We are talking about a 30 to 37% surge in a single week.
To anchor those levels, we haven't seen Brent this high since April of 2024, and WTI hasn't traded here since October of 2023. But the price action is a symptom, right? It's not the disease.
Right.
The market isn't pricing in fear. It is pricing in physical strangulation.
Right.
20 million barrels of crude and petroleum products move through the Strait of Hormuz every single day. That is 20% of the global seaborne oil supply just effectively shut down.
And Vortex's tracking data is putting a terrifying visual to that bottleneck. There are currently 16 million barrels of oil trapped in limbo in the Persian Gulf. You have a massive fleet of very large crude carriers, fully loaded, burning daily charter rates, just sitting in a free fire zone.
You have to understand the logistics of a bottleneck of that magnitude. A standard VLCC carries about 2 million barrels. So you have a minimum of 8 of these massive supertankers representing hundreds of millions of dollars in underlying assets per haul, effectively held hostage by geography.
Held hostage.
And the tactical nature of this conflict shifted aggressively over the last 36 hours. Iran pivoted from localized strikes on military and civilian infrastructure to a deliberate, targeted campaign against global energy nodes.
Yeah, the target list hitting the tape over the last few days is a who's who of global energy infrastructure. They hit Bahrain's Bapco Energy's refinery. They targeted Saudi Arabia's Ras Tanura refinery, which is the absolute cornerstone of Saudi export capacity.
Massive facility.
And they went after Qatar's Ras Laffan LNG complex. That last one resulted in a formal declaration of force majeure.
Yeah, that force majeure declaration at Ras Laffan is a massive structural red flag for the global supply chain. It is not a mere shipping delay.
Not at all.
Force majeure is a legal mechanism where the operator formally notifies global buyers that an unavoidable catastrophe prevents them from fulfilling their contractual obligations. It completely severs the liability chain.
Wow.
When you pair that with Iran's Revolutionary Guards actively threatening to strike any vessel attempting transit, even while nominally claiming the strait is open, you have a total denial of access.
Which brings us to the daily burn rate, and the math here is apocalyptic. Citigroup is currently projecting that the market is losing between 7 and 11 million barrels a day of supply right now. JP Morgan ran the timeline on a sustained closure, and their models show production cuts hitting 3.3 million barrels a day by day 8, and a staggering 4.7 million barrels a day by day 18. Iraq and Kuwait are already cutting production.
We need to unpack why those production cuts are happening, because it's a matter of wellhead physics and onshore storage limits.
Right, it's not a choice.
Exactly. It's not a policy choice. When the tankers can't leave the Gulf, the onshore storage tanks at the export terminals fill to maximum capacity within days. Once you run out of physical tank space, you cannot simply dump crude oil into the desert. You are forced to shut down the extraction at the wellhead.
I want to push back on the permanence of that, though. The market seems to be pricing this as if the taps can just be turned back on the second a ceasefire is announced. If Kuwait is already shutting in production because they have nowhere to put the oil, isn't there a risk of reservoir damage?
Absolutely, and that is exactly what the algorithms are missing today. Shutting in a major producing oil well is not like flipping a light switch.
Right.
When you stop the flow, you alter the pressure dynamics within the subterranean reservoir. In some aging fields, if you kill the well, you might never recover the same flow rate when you try to restart it. The Financial Times cited Qatar's energy minister warning that all Gulf energy exporters would have to shut down production within weeks if this drags out. We are looking at potential long-term supply destruction that the modern options market simply lacks the muscle memory to price accurately.
And when the free market seizes up to that degree, the sovereign steps in. The scope of the government intervention we saw today tells you exactly how much panic is inside the Treasury right now.
Oh, they are sweating.
President Trump ordered the U.S. International Development Finance Corporation, the DFC, to provide up to $20 billion in reinsurance for maritime losses in the Gulf. We are talking hull, machinery, and cargo.
That $20 billion backstop is a direct reflection of the private insurance market completely failing. If you look at the Lloyd's of London syndicates and the P&I clubs that underwrite global shipping, their risk-reward models for the Persian Gulf just broke.
Broke entirely.
War risk premiums have gone parabolic. Private underwriters are looking at a multi-hundred-million-dollar VLCC heading into drone strike territory, and they are either quoting extortionate premiums or withdrawing coverage entirely.
So the U.S. government, coordinating with Central Command, is acting as the insurer of last resort to prevent global trade from freezing in place. But I'm looking at the Treasury's other move today, and honestly, it looks like a paper tiger.
Which one?
They issued a 30-day waiver allowing Russian oil to flow into India to try and alleviate the supply pressure. Brent crude basically laughed at it. The price kept ripping.
It ripped because the physical market knows you cannot replace the output of Ras Tanura and the entire Strait of Hormuz with a handful of sanctioned Russian shipments floating off the coast of Mumbai. Treasury called it a stopgap measure, but it only applies to crude that is already on the water. It was a desperation valve, and the market treated it as exactly that.
The domestic fallout is where this gets highly political, and we have to view that impartially, purely as a variable for market volatility. U.S. gas prices jumped from $2.98 a gallon to $3.32 this week alone. That is the highest level we have seen during Trump's terms.
Yeah, massive jump.
Gas Buddy is projecting a move to $3.40 or $3.55. You have a White House facing midterm elections, a president publicly claiming the market has stabilized, while simultaneously demanding an unconditional surrender and labeling Iran's leadership unacceptable on social media. We are strictly looking at the delta between that rhetoric and the actual market pricing.
The political rhetoric is completely disconnected from the wholesale gasoline market. You have to factor in the seasonal blend transition as well.
Right, the summer blend.
Refineries are currently transitioning to summer-grade gasoline, which has strict Reid vapor pressure requirements to prevent evaporation in the heat. That summer blend is mechanically more expensive to produce. You are colliding a historically expensive seasonal transition directly into a geopolitical supply shock.
But the energy squeeze is only the first domino. There is a secondary supply chain shock happening right now that the broader market is asleep at the wheel on. Let's talk about the aluminum market, because the U.S. relies on the Middle East, specifically Qatar, Bahrain, and the UAE, for nearly 20% of its aluminum imports.
Aluminum smelting is effectively solid electricity.
Solid electricity.
Yeah, the process of converting alumina into base aluminum through electrolysis requires a gargantuan amount of continuous baseload power. That is why countries with massive subsidized natural gas reserves, like the Gulf states, dominate global smelting. When the energy complex in the Gulf goes offline or ships can't move, that aluminum supply just vanishes.
We are seeing reports of absolute chaos on the manufacturing side. Companies like Bonnell Aluminum and RM Metals are scrambling, trying to source metal from India or Northern Europe, and the result is showing up in the delivery premiums. The U.S. Midwest premium just hit an all-time record of $1.075 a pound.
We need to define the severity of that premium for the listeners. The Midwest premium is the physical surcharge you pay on top of the London Metal Exchange benchmark price, just to get the metal delivered to a factory door in the U.S. industrial heartland. Hitting $1.075 a pound is a crisis-level indicator.
And it is being aggressively amplified by domestic trade policy. U.S. buyers were already eating President Trump's 50% import tariffs on aluminum. So if you are an auto parts manufacturer or you are stamping beverage cans, you are caught in a brutal vice.
Caught from both sides.
The baseline tariff constrained your primary supply from places like Canada, and now the geopolitical shock just wiped out the 20% you were sourcing from the Middle East. It is a dual-front squeeze on input costs.
Which means RM Metals having shipments physically trapped in Dubai right now isn't just an inconvenience. It translates directly to factory downtime and massive cost pass-throughs. The consumer is going to absorb this through more expensive vehicles, appliances, and packaged goods. This isn't transitory. It is structural supply chain inflation.
And that structural inflation is the perfect, brutal segue into the macroeconomic bombshell that dropped this morning. The jobs report completely fractured the narrative that the U.S. economy was heading for a soft landing. The U.S. unexpectedly lost 92,000 jobs in February. Unemployment ticked up to 4.4%.
You are always going to have Wall Street analysts trying to dismiss a print like this as statistical noise. And yes, there were massive healthcare strikes, specifically involving Kaiser Permanente, and severe winter storms that distorted the headline payrolls number.
I hear the storm argument every winter, but let's be real. Do you actually buy that this is just weather and a healthcare strike?
No, you cannot dismiss a 92,000 job contraction on weather. The true signal is in the revisions. The Bureau of Labor Statistics quietly revised the employment figures for December and January downward by a combined 69,000 jobs. That weakness was thoroughly baked into the labor market before the February storms even materialized.
San Francisco Fed President Mary Daly pointed this out. She noted that if you average out January and February, you are looking at near zero job growth. And the demographic baseline makes that zero growth number even more alarming.
The break-even rate for job creation has plummeted. Historically, the U.S. needed to print about 100,000 jobs a month just to match population growth and keep unemployment flat. But due to incredibly low birth rates and the administration's heavily restricted immigration policies, that break-even threshold has dropped to just 30,000 jobs.
Wow.
The fact that the economy is failing to clear a hurdle that low indicates profound structural fatigue.
So here is the ultimate trap. Normally, a weak jobs report means the Fed cuts rates. Not today. With oil exploding higher, inflation is about to rip. The Fed is completely paralyzed. They cannot cut rates while energy prices are doing this. We are staring down the barrel of stagflation.
You have the classical Phillips curve entirely breaking down. Stagnating growth and rising unemployment colliding with a massive exogenous supply-side inflation shock. It is the absolute worst-case scenario for a central bank because their dual mandate is fundamentally at war with itself.
If they cut rates to save the labor market, they pour lighter fluid on the commodity inflation fire. If they hike rates or hold them elevated to fight the oil shock, they choke out whatever is left of the jobs market. The Fed is entirely paralyzed.
Just listen to the Fed speak that hit the tape today. Mary Daly explicitly referred to the oil price shock as a real thing, creating two-sided risks. Cleveland Fed President Beth Hammack cited broad-based inflationary pressures while claiming policy remains in a good position.
Claiming policy is in a good position today is central bank speak for we have completely lost control of the macro narrative and we are not touching the dial.
Exactly.
They are entirely on hold. The geopolitical black swan in the Strait of Hormuz just tied the hands of the Federal Reserve.
And that paralysis is driving the VIX and the broader market sell-off. The algorithms don't know how to price an equity market where the Fed put has been revoked by a Middle Eastern war.
But this is where the smart money separates itself from the retail panic. Let's drastically shift gears and look at the major contrarian trade that emerged today. Because while the entire market was hyperventilating over stagflation and the Middle East, Boeing shares closed up almost 4% today.
In a tape that was bleeding red across almost every sector, Boeing was a massive, glaring anomaly. Bloomberg dropped a blockbuster report that Boeing is in the final stages of securing a historic 500 aircraft order for their 737 MAX jets.
A 500-jet order. And they are also in talks for an additional 100 wide-body jets, including the 787 Dreamliner and the 777X. But you have to connect the dots here, and I want to push you on this thesis.
Go for it.
We just spent 20 minutes detailing how the U.S. Midwest aluminum premium is at an all-time record high because the Middle East supply is cut off. You need a staggering amount of aluminum and titanium to build 600 airplanes. If their raw material input costs are going exponential and airlines are facing a stagflationary environment with spiking jet fuel costs, how is Boeing actually going to profit off this? Isn't buying aerospace right now just catching a falling knife?
That is exactly the friction point retail traders get hung up on, but it ignores how mega-cap aerospace supply chains operate. A 600 jet order is not delivered next quarter. This is a massive multi-year backlog. Boeing hedges its raw materials, aluminum, titanium, composites, years in advance through long-term forward contracts.
Okay, that makes sense.
They are not buying spot aluminum at a 1.075 premium to build a plane tomorrow. Furthermore, these contracts have strict escalation clauses tied to inflation metrics.
So they just pass the cost forward. But what about the airlines? Why would a buyer commit to 600 planes in a stagflationary environment?
Because the buyer isn't just a corporate airline. The buyer is essentially a sovereign state. Look at the timing of this deal. This order is perfectly choreographed to be unveiled during President Trump's state visit to Beijing, meeting with Xi Jinping from March 31 to April 2.
Oh, it is pure statecraft. China is utilizing this multi-billion-dollar Boeing order as a diplomatic centerpiece. It provides the U.S. administration with a massive domestic export victory, and it secures Boeing's production line for the next decade.
Exactly. While the market algorithms are fiercely trading front-month crude oil futures and panic-selling the S&P on stagflation fears, smart money is looking at aerospace as a sovereign-backed structural catalyst.
While the world is watching the Middle East, smart money is watching aerospace. This is a massive geopolitical trade win.
War in the Middle East might disrupt shipping routes for a quarter, but a state-sponsored order of 600 commercial aircraft guarantees revenue streams deep into the 2030s.
That brings us to the actual execution, the Theta Fuse strategy. How do you actually position a portfolio for this? Heading into the weekend, holding naked calls or puts is pure gambling. The weekend gap risk on Middle East news is extreme. Implied volatility on energy tickers is at maximum expansion.
The weekend gap risk is extreme right now. You have an active conflict, a trapped central bank, and a market that closes for 48 hours, while the geopolitical headlines do not. If a facility in the Gulf is struck on Saturday, or conversely, if a diplomatic breakthrough occurs, the market is going to open on Monday morning hundreds of basis points away from where it closed today. Your stop losses will be entirely bypassed.
And the options market makers know this, which is why IV, implied volatility, on the energy tickers is pegged at maximum expansion. IV percentiles are at 100.
When you buy a short-dated call or put in this environment, you are paying a massive Vega premium. The market makers are jacking up the price of optionality to compensate for the extreme uncertainty. If you pay peak premium today for an oil call, you need crude to make a massive sustained move higher next week just to offset the premium you paid.
You could be dead right on the direction oil goes up, and you still lose money because of IV crush. If a headline drops that merely stabilizes the situation, the uncertainty drains out of the market, the implied volatility collapses, and the value of your option evaporates instantly, even if the underlying stock barely moves. It is a mathematical trap.
Which is why you have to look at the contrarian catalyst we just discussed and structure your trade to neutralize that short-term Vega risk. If you want to trade this environment, you look at Boeing, you look at the 500-jet structural catalyst, and you execute this through ABS.
If you want to trade this, look at the Boeing news. A 500-jet order is a structural catalyst. This is the exact environment to look at structuring long-term leap on aerospace, while the rest of the market is hyper-fixated on oil.
By pushing your expiration out to 2027 or 2028 and buying a deep-in-the-money contract, say in 80 Delta, you are isolating the pure long-term structural value of that state-sponsored corporate backlog.
You avoid the noise.
You drastically reduce your exposure to short-term Theta decay, and you completely immunize the position against the vicious volatility crush that is going to wipe out the retail traders playing weekly options next week.
You are substituting short-term anxiety for strategic patience. Finding an isolated, massive capital expenditure like the Beijing-Boeing deal gives you a clean, heavily insulated thesis to trade around, while the rest of the market suffocates on supply shocks and stagflation. We have covered the mechanics of the Hormuz choke point, the Fed's dual mandate nightmare, and the aerospace Leap S strategy. But before we wrap this war room session, we are reading the comments this weekend. Tell us, yes or no. Will oil cross $100 a barrel by Monday morning? Drop your answer below.
The tape on Monday morning is going to be ruthless.
As always, we talk options and strategies here on Theta Fuse, but this is for educational purposes only. We are not your financial advisors. Trade your own plan and protect your capital this weekend.